Okay, good afternoon and welcome back everyone to our options education webinar series. I hope everyone had a good holiday season. I want to wish everyone a happy new year. Today we're here to talk about trading earnings, and I have a special guest, Dan Passarelli, which I'll introduce here in a few minutes. Today we're going to really talk about the earnings season that's just about to kick off. We usually do one of these webinars at the beginning of every single quarter, and this month or this quarter we've brought in a good friend of mine, Dan Passarelli, to talk about his ideas around how to go about trading earnings, bringing a different perspective to going about trading earnings than what we typically teach. So today we have a very special webinar for you. Before we go ahead and get started, this webinar is recorded. So for those of you that are interested in viewing this afterwards, you can, we'll send out the recording about 30 minutes after we finish here today. For those of you that are brand new to Options Play, welcome. Just a little bit of housekeeping to help us get started. For those of you that are interested in looking at Options Play, you can sign up for a free 30-day trial at optionsplay.com. For those of you that are on a trial and looking to subscribe, you can subscribe here for a member for $50 a month or $500 a year. And included in the recording that we'll be sending out after is the slides. So there are some important links in those slides for those of you that are relatively new to options trading or still learning and want to utilize some of the resources here. We have links to all of our previously recorded webinars. I highly recommend, if you're new to options or new to Options Play, to please take a look at those webinars to learn a little bit more about some of the basic strategies you can trade. Take a look at some of our daily trade ideas. And actually, quite importantly, for those of you that are learning about options and want to learn about different strategies, or even some of the strategies we'll be talking about here today, the Options Industry Council is a great resource that you guys have access to free of charge in order to get access to some of this education. There's a wealth of knowledge at that website, so I highly recommend, if you're learning about options, to check out the Options Industry Council. So with that, I just want to go ahead and get started here. I'm going to start off by just introducing Dan Passarelli. Dan and I have known each other for a few years. We speak at a lot of the conferences together, the money show that's coming up or the Traders Expo rather in March in New York. Dan and I will be there at the Traders Expo to speak. So for those of you that are coming out to that, please stop by our booths and say hello. And with that, Dan, I'll let you introduce yourself and talk a little bit about your background and kind of the aspect, if you will, that you bring to the table as a previous floor trader on the SIBO.
Okay. Hey, thanks, Tony. Hi, everyone. So I'm Dan Passarelli, and I've been in the options business for a really long time. Started down on the trading floor back in 1993 as a runner, which means I started at the bottom and worked my way up to being one of the biggest traders in my pit as a market maker at the height of my professional trading career. But what's really interesting, I think, and the way that I feel I can offer a unique advantage to our students is that, I started out with that professional trading background and did that for a long time and had a successful career down on the CBOE trading floor. But then the exchange asked me to teach some classes. And so I figured I'd give it a try. And I went around and I worked with a lot of different retail traders. And as a matter of fact, that was the first time that I started trading what your broker calls a retail trader, just like in a regular brokerage account. And truth be told, it was actually a challenge. Seems kind of really counterintuitive, doesn't it? Like started out as a professional trader, did really well, and then sort of seemingly went backwards, I guess you would think, and traded in just a regular old account and kind of struggled a little bit. And then I kind of worked out a lot of different types of systems, I kind of put everything into a checklist and I kind of figured out all the steps that are involved in order to make a good trade, because I needed to do that for two reasons. One is to be able to explain it to other people. And B, I found that it really helped me a lot with my personal trading. And I was able to overcome that new hurdle I had and start enjoying the success I was used to. So that's a little bit about me. I probably went on way too long. I'll pass the ball back to Tony.
Thanks, Dan. Thanks for that introduction. And I really believe that that's exactly, the story that a lot of professional traders have. They trade on the floor, which is quite different from trading when you're on the other side as a retail trader. And that's really the struggle that a lot of, the people that are here on the webinar probably have is, learning how to trade as a retail trader. So it's really good to have you, come in as a professional trader and then relearn basically how to trade as a retail trader, because that's really what everyone here on the webinar is going through. Just to, for those of you that are unfamiliar with who I am, my name is Tony Zhang. I'm the chief strategist here at Options Play. I'll be walking you guys through the webinar today. We're going to do a bit of an interview style. I'm going to start off introducing a little bit about just the earnings season coming up. I'll talk a little bit about what we saw in Q3 of earnings, what is our expectations for Q4 earnings season. And then what I'll do is we'll kind of go a little back and forth with Dan, talking a little bit about, how he prefers to trade earnings. What is the strategy he likes to trade? It's a little different, and it's a new strategy that we certainly haven't touched up on. We're going to be talking about time spreads today. He's going to be introducing that strategy. He'll go through some examples, and then we'll look at some stocks that are reporting earnings over the next couple of days to show you some examples of how to go about utilizing a time spread on these names. So I'll start off by talking a little bit about 2018 Q3 recap and a little bit about what we're expecting in Q4. So Q3 was very similar to previous quarters, very strong earnings and profit growth across the board, across the S&P 500 stocks. I think the one interesting new theme in Q3 that we saw was that, we started to have this tariffs and trade wars started creeping into earnings expectations. And we had about 15% of S&P 500 companies report that they were in some way, shape, or form negatively affected by tariffs. So that's something that was a new theme that, clearly is something to pay attention to in Q4. That is a new theme that we want to pay attention to. What is not new in Q3 that we've actually seen for quite a few quarters now is this theme that stocks that beat on earnings had very small positive moves, yet stocks that missed on earnings tend to have huge negative reactions. This is something that we've actually been talking about for about 3 to 4 quarters now, and this is typical of what we consider late cycle bull markets. We're 10 years into a bull market. There tends to be limited gains that a stock that beats on earnings can have, but the stocks that miss on earnings tend to have huge negative results. So we tend to see some skew to the downside or more opportunities to the downside when a stock misses on earnings than stocks beating on earnings. So that's sort of the theme that we saw going into Q3. Again, I think the thing to keep in mind was that there was still strong earnings and profit growth in Q3. That in Q4, we are expecting to start to see some of that sales growth decelerate. We've talked about that theme last quarter, but actually corporate profits were very strong. And that was part of the reason why, the sell-off in November and December felt a little overdone because of how strong corporate profits were, considering how strong economic numbers were. I personally had felt that the market sell-off in December was a little overdone. And maybe that's what the markets are showing, right now as they kind of recover a little bit. But the key theme that we're still seeing in Q4 is that sales growth and profits is decelerating. It still is growing, but growing at a much lower pace. And we're seeing that through the revisions that companies are providing, the guidance that companies were providing. A big example of this is Apple creating forward guidance that they're expecting a huge slowdown in iPhone sales. This is the type of guidance that we're seeing from a lot of different companies going across the board. And some of that is tied to the trade wars and tariffs. However, I do feel that that's quite that the effects of that are somewhat priced in based on the huge sell-off that we had in November and December. And a key theme that we want to pay attention to is inflation. Inflation has made companies paying for personnel a little bit more expensive. That's compressed margins a little. Capital expenditure is still quite strong, but it's certainly starting to pull back a little. So these are some of the themes. We're starting to see some slowdown across the board. So that's really what we're paying attention to going into Q4. Dan, do you have anything to add in terms of kind of expectations of earnings this season?
No, I mean, I think we see a little bit of a trend, but I mean, I say that, I mean a little bit of a trend, keep in mind, sales growth deceleration doesn't mean contraction, it means growing, but at just a slightly lower rate. And, all the economic news that we see coming out is pretty conducive with probably not too big of a major change from what we've been seeing. I mean, we're getting reasonably good numbers from stuff. So I think we're going to kind of keep seeing what we're used to seeing. If anything, I mean, if the trend continues to a little bit of growth deceleration, I think it'll be small. So we'll see. We're getting into the thick of it pretty soon.
Yep, absolutely. I actually think the sell-off in November, December provides a little bit more opportunity for some upside in some stocks that have pulled back substantially. So, Dan, why don't you talk a little bit about what are the advantages of trading earnings? Dan? Oh.
Nope, sorry. I muted myself for a second. So thanks, Tony. So earnings are a very, very unique thing to trade. It requires a different mindset, a different trading style than anything else. And I will tell you, when I started down on the trading floor, I was not allowed to trade earnings. When you first start out as a professional trader, you have a risk manager and they give you a little bit of guidance. They give you a lot of leeway, but a little bit of guidance. And I was required to try my best to be flat going into any earnings announcement, because anything can happen. And the story into how I started trading earnings, is after I was a professional. It was when I think it was Bloomberg TV or maybe it was Fox asked me to do my first television interview, from the trading floor. And they said they wanted to talk about Apple because it had earnings coming out the next day. And they wanted a trade idea. And I thought to myself, well, geez, I don't really trade earnings. What am I going to do here? So I looked at it and I studied it and I looked at all the different trades that I could possibly make that made sense going into earnings. And none of them did until I came across one. And that's what we're going to talk about coming up here. I don't want to steal my own thunder too much.
Okay. So do you want to talk a little bit about kind of the slides here in terms of any of the bullet points here? Or do you want to move on to the next slide?
Yeah, let me call attention to just a couple of things. So here's what's really important about earnings and what sets it apart from everything else. It's totally market independent. I mean, unless there is just a catastrophe of a trading day where the market crashes, 10 to 20%, earnings aren't that affected by the market. I mean, a little bit, but people are watching the numbers that are coming out. So in a way, it's sort of a different asset class if you think about it. You're no longer at the mercy of needing the market to go higher or lower if you're a bear. It's an extremely short-term trade, which is very liberating also, because, to me, trying to figure out where the market is going to be a month from now feels impossible with the way the market trades now. Right? It could be 30% higher or 30% lower for all I know. I mean, that's a little bit extreme, but I mean, it could be 15% higher or 15% lower, that's for sure. So being able to keep trades extremely short-term limits your broad market exposure. And it's a set of opportunities what it is a system, and there are a ton of opportunities for about, I don't know, I mean, earnings last maybe about a month long, right? So you get like 4 times a year, like basically 1/3 of the year, you get like a glut of opportunities that can be really, really great, limited risk, potentially high reward. But really, like, one of my favorite things about trading earnings is it's extremely easy, especially when you follow along with a little checklist, and there's basically a simple yes/no test to screen. Is this a good trade? Is this not a good trade? There's no scratching your head. There's no thinking, overthinking it. There's no, elaborate forecasting. It's simply you just go through the checklist that I'm going to talk about. You say, yes, this is a good trade. No, this is not a good trade. And it's easy. But the best thing of all is that they work. And I'm going to show you some of our results that we had from some previous earnings cycles so that you can get a little flavor of how it works, why they work, and how powerful it is that you can drive some pretty good consistency.
Great. So I think what you're saying is that, earnings provide this extreme amount of volatility in this very short amount of time that provides an opportunity to potentially make some profits. And options really allow you to exploit that opportunity with limited risk. And that's really what we're here to talk about, is that specific strategies to how to go about doing so. So Dan, here, why don't you talk a little bit about your list, or how this works?
Sure. So this is, it's a system that requires learning a little bit of the background for each of these steps. But I want to go through each of these steps, and I want to go pretty deep into maybe 1 or 2 of them. So the first thing that we need to look at is what we call the yes/no screen technique. It's very, very simple. It's a volatility-based technique. And for those of you who are brand new to options, I've got a video, a webinar that I'm going to talk about a little bit later, where I'll go into a little bit more depth to sort of catch you up on this. In fact, for everybody, a little bit later, I'm going to tell you about a complimentary webinar where I can catch you up on all this. But let me give you the gist of it. The yes/no screen technique is a volatility-based screening where we compare the volatilities of the 2 options that we're going to be using. If they line up a certain way, the answer is yes, this is a potentially good trade and I can go on to the next step. If the answer is no, it's not a very good trade and I have to, move on to the next opportunity. And of course, we're trading during earnings season. There's plenty of opportunities. So how that works is we want to be buying a lower volatility than we sell. We want to buy low, sell high at the same time. Now, again, for people who are a little bit newer to options, that may sound a little bit esoteric, but it's really, really powerful because what it does is it gives you an edge, like what's really special about the market taker proprietary earnings trading system is that it's not, there's no, it's a solid system. There is no guesswork. There is no forecasting. There is no predicting. There's no hoping. What we're doing, instead of sort of coming up with a position and making our best guess and hoping it works out, and that's a little bit of an oversimplification. I mean, people who are successful as a trader, there's no hoping, but we're taking it a step farther than most traders and looking at it more as a professional. This is basically a professional-based strategy for non-professional traders. We're looking for anomalies, okay? We're looking for situations where the market is giving us what I call and what other professional traders would call an edge, which is a statistical advantage. All right, so then we're going to run the is-was check, which that one's the only somewhat complicated step in this whole bit. So I can't really get real deep into there, but basically what we do is we look at our break-evens on the trade going into this particular trade, and we compare that to historical prices to see if it's a reasonable trade. We see what our break-evens are now compared to what our break-evens were historically in the past, and then we develop context. Now, the third thing here is we want to fill out the earnings time spread risk checklist. Okay? So with any trade, we always need to know two things. We need to know what our risk is and how much we can make. Now, what we tend to focus on, of course, is how much can we make on this? You know, that's the exciting part. That's why we trade. But the one that's more important is what we can risk, is what we are risking. And so we need to monitor that very, very closely. This is one of the things, earnings trading aside, for any option trading, this is one of the things that really separates the people who make money in the long run versus the people who give it a go and it doesn't work, and 2 years later they find some new hobby, real estate or something like that. So we need to fill out our earnings time spread risk checklist so we know exactly what our risk is, and we've got our plan, and we can make a relatively safe trade. Then we set up a time spread trade before earnings, which we'll explore a little bit more after this. And then we follow the MTM proprietary earnings trade technique. We set it up, we put it on, we have our risk management parameters all in our little checklist, and all we do is follow along. And then we take off the time spread. I won't say immediately following earnings, but very, very close to following the earnings announcement. We don't let a lot of time pass. And then it's rinse, wash, repeat. We're going to repeat this on the strongest earnings candidates throughout earnings season over the next 5 weeks, or whatever it is that earnings lasts. We've got literally thousands of different stocks to choose from during earnings season. We're not going to trade them all, but if you can make 1 or 2 or 5 or 10 a day, depending on how you hone your skills and are able to follow along with the MTM proprietary earnings trading technique, if you can just make a couple a day throughout earnings season, and you're cherry picking, only picking the exact best earnings trade candidates, man, this becomes a super powerful system.
Well, Dan, that sounds great. So just to clarify for some of those of you that are relatively new to options trading, what a time spread is. A time spread is where we're buying and selling options that are of different expirations. In this particular case, what we're doing is we're buying an option contract that's further out in time and selling an option contract that's shorter dated compared to the long leg. And as Dan said, one of the most important pieces to all of this is really understanding your risk of each trade before you get into that trade. And that really is, like Dan said, applicable to all types of options trading, not just, this specific strategy that we're going to go over here today. So sounds like you have a very specific checklist. Dan, do you want to move on to the next slide where we kind of go over an actual example of this from last season?
Yeah, let's do that. I want to throw one more thing out there, though. You kind of reminded me. I took a note about this. One of the key things about this strategy is that, Tony mentioned earlier that what we've been seeing lately is that when a company has a miss on earnings, there can potentially be a pretty huge negative reaction. So as everyone's intimately familiar with who's ever traded a single option contract, options are pretty leveraged. Like you can, I mean, with some strategies, you can potentially have unlimited risk. So it's extremely essential that, because there can be a potentially huge negative action, action following earnings when they miss, we want to make sure that we have not only limited risk, but also a plan to further limit the risk that's already limited.
Okay, thanks, Dan. So let's move on to an example from past season. Why don't you walk us through this McDonald's trade?
Yeah, so this was, I don't know, what was this? Couple earnings ago, I think it was. I like to use pretty historical examples. And this one, I mean, it just played out really, really nicely, not perfectly, so it's a very realistic example, but it played out really nicely, and it worked just how it's supposed to work and how it can work often. So we're looking at McDonald's. If I'm not mistaken, this was the day before earnings was scheduled to come out. And we can look up here. Here's the date. Okay, so this tells us exactly when this was. They were coming out the next morning, BMO, before market open, right? And so I took a look and I looked at the chart. Now, this is a reasonably good chart for a potential earnings candidate. And this is one of our starting points. Now, why is this a potentially good chart? Well, because it's fairly flat. What we're not looking for is a stock that's all over the place. We're not looking for a stock that fell 10% last week, or, something like, Canopy or something like that, where it just blasts through the roof. We're looking for just a regular old company that doesn't have any out of the ordinary volatility, especially recent.
Okay, great. So do you want to move on to the next slide and talk a little bit about the trade that you made off of that?
Yeah. So here's the trade. This is the session just prior to the earnings announcement. So, earnings can be announced after the market close or before the market opens the next day. So either way, if earnings was to be announced after the market closes today, this is the session before earnings. If it's to be announced before the market opens tomorrow, this is the session before earnings. So that's what this was. It's the day before. In fact, it was the afternoon before the morning of earnings announcement. So what we did is we looked at the expiration that expires just following earnings, which in this case was the October 27th, 165 calls. We're using the nearest to the money. And we bought the November 3rd, 165 calls. We did we went through our steps and we determined which expiration was better. This was the ideal expiration to buy. And so we constructed a time spread in the same manner that Tony described. We bought the Nov 3rd 165 calls at 211. And then we sold the October 27th 165 calls at $1.75. So that ends up being a debit. We paid 36 cents and we put on the time spread just going into earnings, following, of course, doing some of our other analysis. But, let's put it into simple terms here. This is the trade we made. This is how we did it. Let's take a look at what played out next. Okay, so remember, we paid 36 cents for this trade. Now, we didn't, you wouldn't want to just buy one contract. Now, if this is the first time you're trading earnings, you probably want to just buy one contract. Whenever you're trading any new style, technique, methodology, you run the potential of, making a silly mistake here or there. You want to kind of get your feet wet. You want to see what it's all about. You want to test it out. I love the idea of paper trading. I also love the idea of trading really, really small. With a time spread, you can only risk what you put into the trade. That was 36 bucks. So we paid 36 bucks a contract. Let's just say we traded a one lot because we're brand new to this. Here's what happened. The day after earnings, remember we were short the October 27th expiration 165 calls. We were long the November 3rd expiration 165 calls. The underlying moved. Now, it actually gapped higher at the time of this screenshot. It was up 1.4% or $1.86, which is not that big of a move. Now, this is a very, 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 very interesting strategy. You know, the more you learn about this, the more interesting it becomes and the more powerful you can see it. But what's really interesting about it is that on earnings, you expect the underlying stock to move. You know, Tony pointed out, you know, that's where you can see a lot of volatility, you know, during earnings season or when an individual stock announces earnings. So on the one hand, you know, you might think, well, wait a minute, like a time spread is one of those strategies where maybe too much volatility could be bad. So that's what I'm saying. When we follow the system, we're sort of looking for that sweet spot. We're looking for these diamonds in the roughs, and we're going to cherry pick these best trades where basically the time spread is so far out of whack that it puts you into a high probability of high profit trade. And here's what we did. We were able to buy back the October 27th expiration 165 calls at $1.29. We could then sell out the long that we had in the November 3rd expiration 165 calls at $1.81. And we were able to collect a credit of 52 cents. Now, you look at this, for those of you who are pretty experienced trading and you've executed a lot of trades, you know that this 52 cents here, you could actually have done even a lot better than that because these markets are very, very wide. Of course, I have something that if we have a little bit of time later here today, I can tell you a little bit more about. Otherwise, in the webinar I'm going to tell you about, I'm going to tell you all about how we manage the wide bid-ask spreads. But the point I'm trying to make here is, you know, we paid 36 cents for something we could sell at 52 cents. What does that end up being? 44% profit, right? Thanks. I knew I had those numbers somewhere. So a 44% profit, which again, if we manage the width of the bid-ask spread, could have been a ton bigger even. So, you know, just to kind of put this into perspective, if we made 16 cents on a 36 cent trade, you know, 16 cents of option premium is $16 of money. If this was a 10 lot, we would have risked 360 bucks. You know, for those of you who trade options, 360 bucks is not a lot of money. You know, you probably risk that on most of your trades. And we were able to generate a profit of $160. And in this case, it was actually overnight in less than 24 hours. So there's a couple of things. When I say that this could have been better because of middling the markets, that's really only kind of half the story. You know, by following our 25-20 middling rule, we could have done better than that. But there's yet one other thing, and that's the optimal timing. This was one screenshot that I took. You know, on this day, I was engaged in trading markets. I was engaged in teaching some of our classes, working with some of our students. I was literally not staring at the screen all day long watching this. There were times during the day where the prices lined up even better and I could have gotten out at an even higher profit. And so, you know, if that's your situation, like you have a day job, you don't sit and stare at the screen every day, this can be a really, really great strategy for you. If you do sit and stare at the screen every day, this can also be a really, really great strategy for you. You know, you have the luxury of watching every tick, but the point I'm trying to make here is you don't have to.
Okay, great, Dan. So I think what we'd like to do is maybe go through some examples of stocks that are reporting earnings coming up and take a look at some of these.
Yeah, that sounds great. Let's do it.
So let's take a look at you mentioned SunTrust Bank. So tell me a little bit about why you decided to take a look at SunTrust Bank.
So what I wanted to do here is I wanted to pull out a couple of stocks that have earnings coming out tomorrow before the open and do it a little blind. I wanted to have some potentially good opportunities, some potentially bad opportunities, and just sort of show you, give you some starting point of what to look for today, so when you're looking at earnings, even tomorrow, you have some great context. So, okay. Yeah, so SunTrust here, if you look at it, this is one of these scenarios where, I mean, how many sessions ago was that when, we can count the number of candles less than 3 weeks ago, we were $10 lower. This stock rallied up over 20% in less than 3 weeks. So, that is something interesting. Now, there's some people who trade earnings and they'll tell you, hey, one thing you can do with earnings is you can buy it, a few days before earnings comes out because it has somewhat of a statistical advantage of rallying. And there's some truth to that, but there's a lot of risk to that. That's sort of just going off past, you can back test it and you can see that there's a little bit of an edge there, but there's a lot of risk. Because if a stock can go up over 20% in 3 weeks, guess what else it can do? It can go down just as fast, and usually stocks go down faster than they rally. So that's why we stay away from that style of earnings, and we only trade the numbers. We let the market show us exactly what to do. We put it on for a statistical edge with a fraction of the risk of doing a more speculative trade like this. And we set up we could potentially set up a time spread. Now, I will tell you, like Tony's setting up a time spread here, and let's explore it on this. Now, truth be told, though, I probably wouldn't do a time spread on something like this just because it's experienced so much volatility leading up to the earnings event, so much one-way directional volatility leading up to the earnings event. So, but just as an exercise, for this first one, let's look at a time spread. So the stock is at, what was it, 57, 58, something like, 58. Okay. So we want to look at the closest to the money. We could use calls or we could use puts. It actually doesn't matter. I tend to like to use the out of the monies, but it's a pretty small difference here. And since this is just an example anyway, again, this is not one that I would recommend. We're just going through this as an exercise to show you what a time spread looks like. We'd sell the January 18th 57.5 calls at 116. And then we would buy, and let's just go to the next expiration, right? The February 15th to 57.5 calls, we'd buy those at 210. So that establishes us a time spread. So Tony is showing you here, are you able to show him kind of like what the risk is and
Yeah. So let's just jump over to options play real quick for that. So what we're doing here is we're going to go call calendar, and we're going to do the January, February 57.5 call. So this comes out to be a $94 trade, giving you a max reward of $92 and max risk of max risk of $94 and max reward of $92.
Not too bad potentially, right? Now, what is actually a lot more attractive, now again, conceptually, this is again one, we haven't done the volatility analysis, we haven't done the is-was test or anything like that, but let's just talk conceptually about the power of time spreads in and of themselves before we get into earnings, which we'll look at when we get to Schlumberger and maybe the other one. We risk one to make one, right? like our risk is, what was it, $93? Our potential reward was projected to be about that, also maximum. But guess what? Even though our maximum risk is $94, that could potentially happen, but we want to put safety precautions into play so that we are not likely to lose that, and our real risk can be potentially a fraction of that. So, okay, let's move on to a trade. Schlumberger we can talk about. Now, this one might be a little bit better. This, like most of the stocks, for those of you who are watching this live, most of the stocks lately have had a pretty good run up over the past couple of weeks, and Schlumberger is no different. It was up about $6. That's on a $36 stock. Yeah, I mean, it's pretty strong too. It did narrow out, it did sort of level off here going into earnings, which I like to see. And it's actually very common to see those sort of volatility bands, if you will, tighten up, and everybody gets into sort of a wait and see attitude. I like to say that the historical volatility drops while the implied volatility can potentially create an advantageous scenario. So let's look at the option chain. So Schlumberger is at 41. Now, if we do our volatility analysis without going into too much depth here, we do have a little bit of a skew in our favor where we can sell. Hold on a second. Yeah. Well, if we look at the January 25th expiration, we could potentially sell a higher volatility than what we can buy, which is exactly the kind of thing we're looking for. The stock's at 41. We want to go closest to the money. In this case, we could pick either the 41 puts or the 41.5 calls. We've got the 41 puts pulled up. Perfect. So we could sell those 41 strike puts at 118. And then we can buy the further out 41 strike puts at 149. We can look in options play because they do a great job in explaining the risk and potential reward to that. Saves us a whole bunch of time in, drawing out profit and loss diagrams and that kind of thing. So, okay, so Tony, what do we have here as a maximum risk and projected potential maximum reward?
Max risk is $30, max reward of $56. These are for the puts. Yeah. We were looking at the calls before. Were we looking at the 41s or the 40s? 41.5s.
For the calls, I would look at the 41.5s.
For the calls, you would look at 41.5s. So that has a max risk of $32, a max reward of $59. And then for puts, you said you'd look at the 41s. Is that correct?
Exactly.
So for puts, you have roughly the same, $32 max risk, $53 max reward.
Yeah, remember, we always want to go closest to the money, but the out of the money version. Because of put call parity, it actually doesn't matter if we use a call time spread or a put time spread, because they're what we call synthetic equivalents. And so the only thing we really care about is we prefer to use the slightly out of money for a few different reasons. All right, and did we want to look at one more? We got time to look at one more? Or?
Yeah, I think we're looking at VF Corp. This reports earnings tomorrow. Mm-hmm. I think relatively similar price chart, not a huge rally over the last few days and really kind of petered off in terms of volatility over the last few days. Trading just around 73 level right now. So let's pull up an option chain here. So it's trading at 73.25. So we could look at the 73.5 calls. Mm-hmm. Selling the 73.5 calls, you can sell that for 210. buy the longer dated ones for 320.
Mm-hmm.
So let's take a look at that in options play. Oh, whoops. Using the natural price, we got a max risk of 110, max reward of 120. If we use the mid price, that's substantially different. Max risk of this obviously has a huge spread between the bid and ask price, but even at the natural price, the worst possible execution price, you have a max risk of 110 and a max reward of 120.
Yep. So here's what I hope that this did for everybody. And I guess we can probably start getting back to the slides. Here's what I hope that this did for everybody. Showed you the power of what's possible with time spreads, right? And what's possible with using them to trade earnings. Now, time spreads are not the only strategy that we teach to trade earnings, but it is the one that we use the most often because it's the one that can give us the greatest advantages while giving us limited risk and potentially some substantially leveraged reward in a very, very short period of time. So none of these trades, we didn't have to, there's several steps in the process. We didn't have time to go through the entire checklist on each of these. So these are not necessarily recommendations or anything. These are to kind of show you the power of what's possible. And if you follow up and you learn the system, what you yourself could be able to do in a very, very short period of time. And so here's what I want to do. I'm going to have a whole lot more time to go a lot deeper into this next week. And this is free. This is not, I'm not asking you to buy anything or anything right here. It's a webinar called 3 Ways to Make January and February Your Best Months of 2019. Now, one of the strategies that we talk about, and the one that we're going to spend the most time on, is going to be the MTM proprietary earnings system. So if you found this interesting and you kind of grasp some of the concepts and you want to learn some more, it's going to be on Wednesday, January 23rd at 3:30 Central Time. All you have to do is go to markettaker.com/OP for options play. So it's market like stock market, taker like take something.com/OP. Notice it's 2 T's in a row. And just register for the complimentary webinar. And I'm going to walk you through the system. I'm going to show you the 25-20 rule. I'm going to show you, introduce you to the is-was technique so that you can see how that works. And I'm going to give you some historical data to show you that this really can work when implemented as part of a system.
So thank you so much, Dan. Thank you so much for taking the time out this afternoon and going through with us kind of the basic concepts of a time spread, what to look for, a few examples. Like Dan said, if you want to learn more about the strategy, there's a whole lot that I think the nuance of trading time spreads that Dan will be able to go over in his webinar next week. I highly recommend for those of you that are interested in looking at time spreads to take a look at that. It's a strategy that we typically don't trade a lot here at Options Play, but it's certainly a strategy that I think is very useful for specific use cases like trading earnings. Again, Dan, thank you so much for taking the time out this afternoon. So at this point, what I'll do is I'll open this up for Q&A. If you have any questions regarding anything we went over here today, the time spreads or any of the earnings that are coming up, please type them into the chat window and the Q&A window, and Dan and I will spend a few minutes and answer as many questions as we have time for.
Tony, could it be that we did such a great job explaining things that nobody has any questions?
Usually we have a few questions, so let's give it a minute here. Please type it into the chat window if you have any questions regarding anything that we went over here today. If anyone can hear me, just type yes into the chat window, just so I know that everyone can hear me. Okay, looks like people can hear me. Please give a link to the webinar for review. We will send out the webinar to everyone in about 30 minutes after we finish this. Kathy is asking the system you guys want to sell. Kathy, if you don't mind expanding on that question, please, that would be helpful. Steven's asking, do you have any good way of screening for eligible stocks? I think that's a pretty good question, Dan. What is it that you are looking for in terms of the underlying stock for these types of earning plays? I think you kind of touched up on it, but maybe you could just revisit that.
Yeah, so there are a few steps within the checklist. One of them is liquidity based, or one of them is stock price based. The one that I talked about here, which is one of the most important, it's the one that we call the yes/no test, and it's one of the first ones in the whole process. Is there an implied volatility advantage? Am I able to sell a higher implied volatility than the one that I'm buying? Now, again, if this is your first exposure to the words implied volatility, you might think, well, why does that matter? Why do I care? Why is that important? Of course, a little bit of a longer explanation than we have time here, but not that long. That is one of the things that we cover within the proprietary earning system. But that's the most important one. That's why we call it the yes/no test. If the answer is yes, I can sell a higher implied volatility than I can buy, then I could go on to the next step, and it's probably going to be a pretty good candidate for me. If the answer is no, I'm not able to sell a higher implied volatility than the one I'm buying, then no, I rule it out and I move on to the next stock that has earnings coming out either after the close today or before the open tomorrow.
So Dan, just to follow up on that, how often do you find an opportunity like this where the short dated option does not have a higher implied volatility than the longer dated option? Is that somewhat common, or how often do you kind of see that?
Well, there are some parameters there. That's a little bit of an oversimplification, but most of the time going into earnings, it's set up within our parameters so that the answer is yes, so that you can sell a higher implied volatility. It's got to be a certain amount higher. It's got to be within a certain range. And so there are some, believe it or not, there are some that we rule out because they don't fit into our yes/no test. And when we do, that's a blessing. It's not a problem to turn down a bad trade and walk away and go to the next one. That's the power of the system. We don't want to just go out and make 1,000 trades and just trade every earnings there is with the time spread, because we'll lose our shorts. We want to be able to cherry pick just the best ones.
Great. So Michael's asking, you mentioned limiting your risk after you set up the spread. Please amplify, but I'm guessing he's asking for you to just expand on that.
Yeah. So part of that is this trade comes off the day after earnings. That's the rule. You have to take it off within the trading session immediately following earnings. Why? Because though there will be some times where you hit your max loss, it's not that often, but there will be some times where there's just such a gigantic gap that, hey, that's one of the lemons. Your goal with trading this system is not to make one trade and risk having one of the lemons. Your goal is to learn the system, get the checklist, follow it on many, 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 many trades this earnings season, many next earnings season, many the season after, until the end of time. Make hundreds of earnings so that, one bad trade just puts a tiny little dent in the, in the amount of profits that you're potentially able to collect over a lifetime of doing this. So we take it off the session immediately following so that there's still some time premium, left in the time spread. That's the most important part. If again, one of my goals here today is to give you, some information so that you can get started using this right away. And then again, like I said, people are really interested in this. I'm going to show you the rest of it later in this free webinar, but I want everybody to be able to walk away with something that they can use tomorrow. And if you want to limit your risk, as long as you take it off the session immediately following earnings and you stick to that, you're going to be limiting your exposure, limiting your risk. Your losses in the long run are going to be truncated. They're going to be smaller. And you're still allowing yourself plenty of profit opportunity.
So I think that segues nicely into the next question here. Gerald's asking, effectively, where do you see the largest losses on upcoming earnings? And I think you touched up on this, but I think what Gerald is looking for is that, how big does a move have to be in order for you to have your max loss on one of these trades?
I mean, they're somewhat rare. In order to have your max loss on one of these trades, you've got to have a gigantic move. So what's really powerful about these trades, though, is that they are able to withstand a great deal of volatility when they're set up right. Not just any old time spread, but one that's set up right within, the parameters that we talk about. You can see a pretty substantial gap where you look at it and you go, I've got a trade here where I don't want a big gap. I had a big gap. And then you look at the prices where you're able to take it off. And because of the edge that we're putting on our side, you go, holy cow, I can actually still make a pretty good profit on this.
Great. So there's a question here from Wayne, which I do want to touch up on, but I actually want to come back to Wayne's question. And his question was regarding, open interest and volume. One of the things that we talk about here at Options Play is not necessarily always using open interest or volume to gauge liquidity, but using the bid-ask spread. Maybe you could shed a little light on kind of looking at volume or open interest as a factor of liquidity.
No, for this, volume and open interest is actually a very poor measurement of liquidity. We're not going to be looking at that. Now, some people hear me say that and they say, wait a minute, that can't be true. But it is. We've got a much better way to look at it. It's much simpler. I actually have kind of like a funny little personal story, like anecdote that relates to the error of using volume and open interest as a measure of liquidity when there's such a simpler way to do it. So yeah, skip all that. I'm going to show you a much easier way.
Great. So Michael's asking a great question. Using the system, how many trades do you expect to make, both in the number of trades and dollars? I think maybe number of trades is probably an easier way to answer that question.
Yeah. So once you get into the groove, let's say, you can put on, I think it's reasonable to expect to be making 10 to 20 trades a week with this.
During earnings season.
Yes, during earnings season. Now, you also have to appreciate that about 70% of stocks announced during what we call earnings season. If there were a video, I'd be making air quotes here. I am making air quotes, but you can't see me. So, I mean, this is actually kind of a year-round thing, but it's very much concentrated into what we refer to as earnings season. So, yeah, once you get into the groove, you've got the system pretty well down. You've got your sea legs. You can make 10 to 20 trades a week doing this. Now, when you first start, though, Michael, you're going to maybe paper trade. You're going to maybe trade some one lots. You're going to kind of trade one today and wait and see how it goes, and then trade another one and see how it goes. But there's power with any trading system, especially this one where there's a lot of trades in a short period of time, there's power to doing more than one trade a day. Because you know what happens when you do one trade a day? You watch that trade and it goes against you and you go, oh no, it's going against me. What should I do? And you know, you have rules in place because we give you the rules. You have rules in place, but you get emotionally attached. So in order to really make the system work, because since you're always doing it for statistical edge, it's basically like being the casino, you know, like if the casino has one person who comes in once a year to make a bet, they're not going to be a very successful casino. If they have a whole bunch of people coming in, making a whole bunch of bets every day, they're going to be a very successful casino. So you want to be able to get to the point, you'll be able to do it very quickly, get to the point where you're making several trades a week. So you're grinding out that edge with consistency.
Okay, well, Dan, I just want to thank you so much for taking the time out this afternoon. I think we're out of time here today. So thank you so much for taking the time. And just as we said before, this webinar is recorded. We'll be sending out the recording in about 30 minutes afterwards so that you can look at or review the video. Also, we'll be sending out the link to register for this free webinar next week with Dan to talk more in depth about time spreads. Any last words, Dan, that you'd like to add?
No, you know, I'd just like to thank everybody for showing up. You guys had some really great questions, which I was excited about. You know, when people ask great questions, I know they're engaged and they're excited about it. And I'm excited about this. So I'm glad you are too. Tony, thanks for having me. And everybody, thanks for letting me spend an hour with you.
Yeah, thanks, Dan. And we'll be back next week. We're actually going to be coming back next week talking about money management. Very important thing. Part of the reason we're taking a step back from talking about option strategies to talk about money management was because, you know, December was a tough and challenging time for a lot of traders, including us. So we really want to make sure that everyone is applying the correct money management and allocation to each individual trade. So we'll talk about, you know, how to go about positioning, how to position size based on your account size. Those are some of the things that we're going to review next week. So we'll see you next week. And thank you everyone for taking the time out this afternoon, and have a great evening.